All right. Good morning, everybody. Um, the morning briefing is recorded and stored on YouTube, and I want to build out that page next year, get my YouTube up and running. This is a little bit of a challenge from someone who watches all the time, says we should do more to get it out there. Can't disagree. So do me a favor, go over to the replay and or the YouTube, find my video, like it, subscribe to the channel, all that good stuff. It's my big focus for next year is to grow out that channel. So I'd really appreciate it. Help me out. All right, this is the last full week of the year. After this, it's going to be holiday weeks. And a lot of traders just take this time off. They don't fight the short weeks. We are in OPEX, depending on the broker that you use. You may have a new contract already, or you may need to roll that contract. On Thinkorswim, you can go into the options tab and it'll show you what contract you're on. So uh, Thinkorswim does it on the Monday before it expires. So you can see the old one is still there. If you want to manually do it, if you're on a broker that doesn't roll automatically, one of the going tips or tricks that people use is looking at the volume on the front option, the one that's going to expire in 4 days, and comparing that to the option on the next series out. The idea would be that if the old contract, the one that's going to expire, has more volume than the front one, you could consider continuing to trade it. But once they swap, you want to trade the one with the more volume. There's also open interest to consider. It's not something that a lot of futures even know exist because, open interest is a bit more like option related, but options were built based on futures markets. I know a lot of people don't grasp that. Because of this change in contract, you're going to find strange gaps, and brokers do a really bad job working with these gaps. They'll fix the gaps in a couple days for the continuous contract, but in the meantime, you could find a significant range between where the other contract was and the new contract starts. It will settle in a few days. It's not a real quote gap because they're going to make it disappear. And of course, that always messes with new traders too. If on Thinkorswim, you can see I just turned the volume on and I went into the settings and turned on the open interest. And we can see that the open interest is taking a nosedive there because they're exiting out of their old positions and they're going into their new positions. So if I was to jump this out a little bit and put the volume back on, you'll see that it's a consistent thing. At every contract change, you'll find that that happens, right? The open interest dips and then it comes back up again in the new contracts. So just the way it is, right? You kind of get used to it after a while. Remember that in the futures, you're trading the future S&P or the future NASDAQ or the future whatever it is that you're trading. So there's the index itself, the S&P 500, SPX or SPY, and then there's the futures of that index. And they are different prices. The previous contract, 68.61, the new contract, 69.21. So you're looking at 60 points difference. It's not like we're just talking, a couple of ticks, who cares? You're going to notice a 60-point gap or a 60-point change in price. We're going to see these sort of issues mess with new traders all week. So I'm just stressing here, be careful. right? There's no reason to get in a rush and get hurt, blow money that you didn't need to blow. Just take your time, understand what you're trading, or sit out and don't trade. The market will be there tomorrow, I promise. So we are green around the world. China's down the least, then Europe, and then the US. That is also the market open cycle. We started with Asia, went across Europe. Now we're getting ready for the US markets to open. When Europe closes today, want to keep our eye on the markets and see how they respond. What do they do? And see if Europe was part of the push that got us up to where we are this morning. Looking at the US, the Dow up near a half, the S&P also, and then the NASDAQ with small caps outperforming everything from the US side of things, up more than 0.75%. We've seen a lot of activity in small caps. And for a while, what we were seeing is an overnight run in small caps, and then they would kind of take a back seat as we got into the open. That dynamic is changing a little bit. We'll see if they can continue to outperform. We're going to get data this week. Some of it's old, delayed data, some not. I've posted about it in the chat. There will be 2 fresh reports to digest: the Bureau of Labor Statistics job report for November and partial October data is due out on Tuesday, and then on the Thursday we get the November Consumer Price Index readings. So are we in bad news is good news, or are we in bad news is bad news? We want to continue to keep our eye on the Fed watch and see what they're pricing in: rate cuts, rate pause, and what does the market think it needs to get that cut. Remember, it's addicted to cuts like a junkie addicted to peanut butter. They really want that cut, right? You know who you are, you peanut butter eater. So they want the cut. Bad news is good news. The market will like bad news because it'll think it's going to get that cut. Recession be damned, inflation be damned, as long as they get that rate cut. So we'll see if the data this week scratches that itch. I'm not pointing fingers. I like peanut butter too. Got some auctions in the front end. By the time we're done with the auctions, we're pretty much done with the data for the day. So we should have a relatively clear afternoon. Unless you really think we're going to get something out of NVIDIA's summit, right? It's supposed to be this afternoon. They really going to shake the market with anything new to say? I mean, do they even have anything new to say? Or is they just going to regurgitate the same old, same old? We could get a surprise from the Bank of England today. Nobody's really expecting that, but it's always possible. And we've got a presentation on the southern border at the White House. Not really expecting anything out of that either. All right, this is Menthor Q. We can see CTA positioning has started to roll back over again. It is following the footsteps of the previous move. If we was to measure the distance from the first move and then lay that over the distance of the second move went a little further. That does not tell us, oh, hey, the trick doesn't work of measuring the distance moved Instead, it says that the distance move was greater than the last distance move because it is accelerating to the downside. So it's a heads up or a warning. It's not an indication that we did it wrong. So measure from, one leg to the ending point of that leg, and then you take that measurement and you lay it at the next spot, and you can see whether or not it's slowing down, speeding up. You can also do the same thing for the pullbacks. Are the pullbacks getting greater? Are they getting shorter? That's just basic technical analysis 101 stuff, right? All the candle books kind of teach that. So this leg down went a little further than the last leg down, and the pullback pulled back a little farther than the previous pullback. They are still in positive territory. They're just reducing allocation or reducing their holdings. Gold took off again, but we are coming back up into that resistance. Or, this is their portfolio holdings. It's a good way to look at it anyways. We're coming back into their previous allocation levels. So are they going to stop at this lower level, or are they going to pile in? It's worth noting that gold is on a breakout, right? It's all the way up here. It's exceeded the previous high, blue sky, and their allocation is not as high as it was these 3 previous times. So keep your eye on gold. If we do get higher than this last high, they could be going for previous allocation. If they continue to pile into it like they did last time, that's really going to help fuel this thing higher. But it doesn't matter if they're getting in or out. Gold can run by itself, right? They were getting out down here, and as they were getting out, gold was running without them. Of course, they, come rushing back in later, and that changed the pace of the tape. The rate of change increased with their participation, but it's not needed. You can also see back here when they got in, that doesn't mean that we're going to see gold move just because they're getting in. They were getting in here, and we were sideways through that whole allocation. So they're not going to move the markets by themselves, but they are a tell to get others to participate. Their story adds to the story. It just adds more people, right? More buys. The SPX closed at 68.22. This 68.50 level is overhead. It's a call wall. Even if we get through that, we got 6,900, which is a bigger wall, 69.50, and then the big 7,000 level. I mean, look how big that is. We could gravitate to that, right? It could act a bit like a magnet and draw us into it, but then we get stuck around it. It's more likely, though, that we reject off of these lower levels before we get close enough for that to act like a magnet to draw us in. So it is still running the 50s from 68 to 68.50, then 6,900, 69.50, 7,000. For the SPX, we're running 50s. With this NVIDIA event, we'll find out if it was sell the rumor, buy the news or not. But we've seen that weakness. They were selling it. Now we're going to be looking for the other side of that coin. All right, the call wall and the put wall are still in the same spot. We're dancing around the volatility trigger. We're still above 0 gamma. We have a market maker move because of the OPEX this week, it's going to be a false signal. So even if we had a real market maker move, we wouldn't know because it would be buried underneath that. You can see the volumes are light, 38,000. We generally run in the 50s, and anything higher than, mid 50s starts to indicate we're in elevated volumes, but we're not even at 40. So coming in a little light, and that makes sense. We're going to see that number decrease as we get closer to the holidays and into the new year. Then we'll see it pick back up again. All right, we've tested the 20-period daily moving average for the last 3 days, Thursday, Friday, and today. We've cut underneath that 20-period moving average, and we've managed to get back above it. We don't want a close underneath that 20-period moving average, or it opens the door for a move to the 50-period moving average, which is 68.32 cog line. With that big bar behind us, it's now the bar of control. Keep your eye on the midpoint. We got to get through that. And now that we are, we need to keep it. We're hitting the 3. We're above the 10. So these are the 3 moving averages that we got to deal with. If we can get above them, then we don't have anything else overhead to deal with. No other moving averages anyways. So yesterday's mid, get through it, on the other side of it, keep it. We don't want to come back in again. If we come back in, it's likely we're going to break the 10. If we break the 10, we aim for the 20. If we break the 20, aim for the 50. I don't think anybody's looking for a significant breakdown of this structure, right? But this is the entirety of the structure. It's big. Now, we could just go to the end of the year sitting inside this box. It doesn't owe us anything. There's nothing bearish if we just stay in this range, even if we come all the way back down to 6,600. That's not bearish. That's just us sitting in this range. We could even break underneath that wick lower and come back in again. It still wouldn't be bearish. Until we get out of this range and expand above it or below it, then we don't have a bearish or bullish market. We got a market that's holding the line sideways, correcting in time, waiting on something. Hopefully the wait is over, right? We've been waiting for 2 weeks for something. And with OPEX removing the guards or the barriers that's been holding us in place, we should have the opportunity to expand now. I was talking about that the other day, and somebody took that as a bearish tone. I'm not putting a bias in this. I'm not positive or negative, bullish, bearish. I'm just saying that the range should end now, and we need to look for signals about which direction it's going to go now that it has the opportunity to move, whatever way it goes. Okay, so we're going to ignore the market maker move because that's very likely due to the OPEX and the rolls and all that. We are close to the ADR high, half. If we get to one line early enough in the day, we can go to the other line by the end of the day. Again, this isn't bullish or bearish. This is the wave of price in how it moves. It's what markets do, right? So we could get to the other side by the end of the day, especially if we get to one side early enough. And by early, anytime. It could have been 10 o'clock last night, midnight. Just because the line doesn't show there doesn't mean we don't use the ADR for the whole night. If we get above and continue to push, then we've got the full ADR up here, which would still be inside of last week's range. Above that, though, we're basically getting a breakout on the week, right? So it'd be an inside week breakout. To hit the lower ADR half, we'd have to get a break outside of Friday's low. Today's floor pivot is lower than yesterday. That's bearish. Price opened underneath it. That's also bearish. We've hit today's pivot and we're now above today's pivot. It's a wide channel, which implies if we do break out, it doesn't stick. And we've got the SNR lines that are likely spread out really far because yesterday was a big day. So upside 69.54, that's R1, and S1 68.44 basically. 68.55 is the weekly pivot, slightly lower than last week's. That's bearish. We don't want our weekly floor pivot starting to lag, but that's what we're seeing. It's getting weak. It's opening lower than the previous week. So we need to stay above that weekly pivot, close above it at least by the end of the week. We don't want to get a close below it. As long as we're maintaining above that weekly pivot, we're considered to be in a bullish bias. And if we close below it, then we're considered into a bearish bias. Got a really nice distribution from last week. We're tangled up in the value area of last week. The point of control right now just slightly higher, but the point of control is just getting started. We do have two little distributions here, but this isn't the right time frame for a single day. So we'll look at it on another chart. But looking at what we developed last week, we've got the value area 69.40 to 68.90, so a 50-point range. We're sitting inside it, crossing back and forth through last week's point of control. So we know it's not support or resistance. It's more like a magnet. We're just hanging out in that zone. We got to get out of that zone. Ten-day, 30-minute volume profile and TPO. We have a narrower range now. It's about 120 points. It's a really clean distribution, just a straight like bell curve classic signal. And we're hanging out inside the value area near the point of control. We're not looking to see this point of control move anytime soon either. So it shouldn't be a surprise that it stays put, at least for most of the week. If it does start to move, then we would have to build out a spot for it to move to. Got a VPOC from the 12th. Except I think we hit it. Yeah, we hit it. It's not a VPOC. Now, the textbooks will tell you to carry that line forward either way. Carry that one and the value area low and high. Carry them into the next day's trading range. I don't. I've got enough pivots. I don't need more pivots, but you do you. It is worth carrying them forward. They do provide insight. I only tend to carry forward the one that hasn't been hit yet, but whatever. This morning, we've got a bit of a discrepancy between the volume profile's point of control and the TPO's point of control. Either way, you can see we're working on a double distribution We've spent less time up here than we did down here, but we've got more volume up here, more trades down here. We'll see if we just ran into a bunch of sellers, which is what it looks like, and if we're going to be able to get through that wall of sellers. All right, last week we drew the range. Oh, that's great. So this happens. This is why manually doing it can be better sometimes. So Thinkorswim doesn't give us the language in the coding to reach the data that actually makes these ranges. That data comes from here, right? It's looking at Friday's expiration and giving us some insight into the plus or minus for the week as it was when we closed Friday. It locks into place, right? It's static. So we read it on Friday after the close, we mark out the lines and levels, and then we're good for a week. And if you're only doing one market like the SPX or the ES, the NASDAQ, you can just hand draw those and it'll be way more accurate since we can't actually code anything that gets this data. But if you're doing a bunch of things, like say you're an equity trader and you got a whole watch list of stock and you want their weekly expected move on all of those, then you really kind of need an indicator. So there's a really great coder called Mobius, and he built this indicator. I code Thinkorswim, but even I don't understand how he got this thing to work. Either way, it does really good. It's not perfect. Drawing it by hand would be better, but it's really good. Most of the time, it doesn't give us any problems. As you can see, it's broken this week, so we can't use it. This isn't the first time that's happened. If you go in the past, you'll find that little sandwich looking situation on other event closes, like here. It was a contract change. We ended up with a really small broken weekly expected move range. So we have to hand draw the levels this week. Unfortunately, the market's already opened back up. So if you didn't hand draw them over the weekend, then the number that you have now that you're seeing on there won't work. That's a dynamic expected move, and we want a static expected move. Thankfully, Thinkorswim has the go back, so we can just go back to Friday after the close, look at what the value was, and mark it out. So we'll get the weekly range drawn by hand, should be there for tomorrow's briefing. When we were looking at it Friday, the range was narrower than this week's range. So we're going to have to anticipate the market was expecting another hurry up and wait mode situation, even though I think the rest of us are expecting expansion. We're above the 10-week around 1.9%. If we look back, that's nothing. We've been much higher than that. No problem. The issue is whether or not we're finally going to break this lower high that we've been putting in. All right, we can see we kind of topped out here, and then it's just been slowly working its way lower and lower and lower. We've been looking for all of that to change. This has been happening for half a year now, and we still haven't had a change yet. So get above 2, and then we'll focus on the next level, which is 3. What we're talking about with that 3 is that price would be 3% higher than the 10-week moving average. So we're not bearish. We're not overextended. It doesn't owe us any move at this point. We're in a good, healthy spot. Now, looking at the daily, we're basically flat. We're really close to the 10-day. We're not sitting on it, but we might as well be. So if we're basically sitting in the middle of the basketball court. We could go either direction. We could move 1.5% higher or 1.5% lower, and we still wouldn't be overbought. That would just be a regular move, nothing to it, right? So from here, we could really expand higher or lower, still no bias in that, right? I'm not in the business of guessing which way it's going to break. We can just let it break, and whatever direction it does break, that's what we trade. That has served me well over the years. All right, looking at what's down this morning. Bitcoin is down and China is down, barely. We've got a lot of China tools that we can look at. KWeb and MCHI are the two that, hold a lot of weight with me, and they're not down enough. But we got the triple leverage, double leverage, whichever one that is. It's leveraged. That's China, it's down, and then the HSI is down. So China's down, just not a whole lot yet. And Bitcoin, which I noticed Kathy Woods was making statements. It looked like she made some allocation into Bitcoin and Bitcoin names. I have to dig into it later this week. But looking at what's up this morning, we got the VIX up, gold miners, junior gold miners, metals and mining, chips, UFOs. Now, Bitcoin's a good level of risk tell, right? It's a liquidity tell on risk. So is small caps and junk stocks and low float pennies. UFO is has been hot, and that's an emerging space to say the least. It's got a lot of room to run, but it's got a lot of companies that aren't necessarily profitable yet. Emerging markets, that's my China tell. It's positive. So, we got some China names that are down, and then we have obviously some China names that are up, or at least some emerging market names. The emerging market ETF has so much China in it that a lot of us just use that for our China tell. And yet KWeb is down, which is the China Internet ETF. Certainly a discrepancy in divergence. Uranium up, finance also up. So chips, tech, finance, all up with gold. We could get a breakout rally day on that alone. But I'd really like to see that Bitcoin come in and help out. It doesn't have to, but it would certainly help. So, Frank, I'm not quite sure what projections you're talking about, but if you want to see farther to the right, just drag it to the left. If you're just talking about the weekly expected move, it's projected for the whole week, but it's broke anyway, so it wouldn't matter. We could put the weekly floor pivot on there, and it would show forward in time because it's set in place. It's not going to move, right? The weekly expected move is one that doesn't move once it's set. A weekly floor pivot is another one that wouldn't move once it's set. So if I was to put a weekly floor pivot on there, it would project like this floor pivot. That's a weekly floor pivot. It is projecting to the right for the whole week because it's not going to change, but the projection started right here. And it's just a line that extends 5 days because that's a week's floor pivot. So I don't know if you're referencing having room on the right or one of these indicators, but that's it. When it comes to indicators, there's the Thinkorswim workbook. I share a link for that on the YouTube. Might as well click the like and subscribe while you're there. Help me build that YouTube out. That would be a futures trader probably, right? Tom? Yes, I covered that at the start of this. We're in a contract change. You need to roll your contract to the new series. Some platforms like mine run a continuous contract and it auto updates. If you're trading, especially on TradingView or Trade of 8, you're going to have to manually roll that contract. We are now on the March series, and it will be 60 points higher than the other one. Know your product, guys. If you're going to trade futures, you really need to know what you're trading. When it closes, when it opens, there's a lot of markets that don't run 9 to 4. Gold, oil, copper. They also have different expiries. There's going to be a massive gap showing for at least 2 days, and then the brokers are going to normalize that gap and it's going to disappear. It's just a contract change event. Now, even on Trade of 8, you've got a continuous contract, and on TradingView, you've got a continuous contract. That'll help, right? If you run that, but you can't trade that. You got to trade a contract. So you got to pick one. We're on March. So we've got the sectors that we need for a rally, but we would preferably want to see Bitcoin come up and help us out with that. And it's not up by much. I mean, the mags are right at 0.5%. That's our line in the sand. So if we can get, we got XLF, that's generic finance. I'd want to see banks itself, so KRE. We got SMH solid at 100 at 1%. So all we got to do is get the push. The thing is, what's that push going to come from, right? They're going to be removing the levels that were holding us in place, but we still need something to kind of light the spark. There's KRE. It's almost there. Risk on sectors across the top, risk off across the bottom, midline in the middle. So you can see XLF, XLK, and XLY at the top. You can also add to those three communications, cloud computing. Those fit well in that same quote tech space. IGV is another one, expanded tech. So if we have those kind of sectors up in the pre-market, the chances of us getting a breakout rally go up a lot. But by itself, these would struggle to get a breakout. Now the Mag 7 all by themselves could give us the breakout and the push. But we're going to want to see a combination of things. These sectors, the Mag 7, maybe some 0-day flow, which we wouldn't have here in the pre-market. Possibly some news could help us out. A drop, say a move in bonds or yields, a change in gold, something that we can add to it so that it's not just the sectors that is giving us this push. By noon, we should be done with whatever data we're going to get, except for that little thing coming out of the White House today. So look for the opportunity to get that breakout, either based on the news or just on the sectors that are up and some 0-day flows. If we get to yesterday's high or low, I'm going to be looking for a reversal to bring it back in again. So I'll be looking for my 111 or my 1236 off of yesterday's range. I don't really care which side it goes to, right? I'm going to run it back in either way. So if we break yesterday's low, we'll be looking for a reversal off of one of those lines. And if we break yesterday's high, a reversal off of one of those lines. It is more likely that we reverse and come back in again than the idea that we keep it and actually continue the breakout. So that's what I'm going to be running for, the reversal. All right, that's what I got for you guys. Be careful, be safe, keep your eye on the clock. I'll see y'all tomorrow.